Hey everybody, welcome to this first lesson on Introduction to Financial Accounting. So whether you're taking this as a university course or you're taking it in college or you're just, interested in financial accounting, in this short lesson, we're going to discuss the four major financial statements. Okay, so we're not going to get into anything overly complicated, but this is really showing you what the point of all of this is, right? Everything we're going to be learning over the next several lessons is kind of for this. Now, accounting is a way to take all of the financial events that a business kind of goes through. We use accounting to organize these events, to quantify these events, to measure these events, and ultimately to summarize them on these financial statements. So the first of the major four financial statements is called the income statement. Now, it has many names. Sometimes we call it the statement of earnings, but income statement is typically a common name for it. And the income statement is essentially showing you how much money you made or the company made in the accounting period. Now, the accounting period could be a month, a quarter, a year. In this example, it's a year. It shows us all of the company's revenues, which is money that we've earned, all of the company's expenses, right, which is, things that we've paid for, like salaries, like rent, like marketing. And ultimately, it shows us the amount of net income that we made. Net income is also called profit, is also called net earnings. So that is really the purpose of the income statement, right? Here you've got what we call a simplified income statement. A simplified income statement is called simplified because it really has only two sections. It has revenues, all of the company's different revenues. So sales revenue, for example, is the money you've made from sales, of course. Rent revenue, interest revenue, any other types of revenues or gains would go into that section. So we can see that for this company, they had a total of $5,020. Now, this is in thousands of dollars. So this is actually just over $5 million in revenues. And then we have expenses. Again, all of the company's expenses. For this company, if you added up all their expenses, they totaled just over $4 million. So the profit here is $796,000. Now, normally what we see and what you guys are going to have to get good at for your exams is to make a multi-step income statement. So I'm going to show you what this is here. Okay, this is the exact same company, just to show you, right? Our profit is the same, but you see this is a little bit more complex because we go into greater detail. So in a multi-step income statement, we separate our activities by whether they're operating or non-operating. So operating activities would be things that have to do with your actual core business. So if you are a gym, then things like the membership revenue, the cost of the machines or the depreciation on your equipment, the cost of the salaries. If you sell shoes, well, we're talking about the sales of your shoes, the cost to produce shoes, the cost to market those shoes. Those would be your core business operations, right? So in the statement, we have it kind of split in two. The top half of this would be your operating section. So we have our sales, right? What are the sales that we made? Cost of goods sold or cost of sales. And we'll get into what all these mean over the next several chapters very quickly. Cost of sales or cost of goods sold is the direct cost of the goods that you sold. So if I sold you a pair of sneakers for $200, the cost of goods sold would be, what did those sneakers cost me? So if it cost me $20 to make it, that would be the cost of goods sold, okay? Which leads us to gross profit, right? What are we actually making from our sales after we've accounted for the actual cost of the good? Then we have our operating expenses. Operating expenses are basically any expense that, again, has to do with running your day-to-day operation. So what you pay your workers, the depreciation on your machines, if you have any marketing expenses, if you have any other administrative expenses, right? Most of the company's expenses anyways would fall into this section. And we pay for those with the gross profit from our sales. So if we take that gross profit, and again, we're going to have a whole session on, making these in great detail. We're going to make them, but I'm just running through this so you understand what you're looking at. We have our operating income or income from operations. So our main business brought in $990,000 before taxes. And then after that, you have your non-operating. What are all the, revenues and expenses that didn't come from the main business. So maybe you rented out some of your space. That would be a revenue, but it's not operating because you're not in that business. Maybe you earned a little bit of interest on your bank account. Maybe you had to pay a little bit of interest, right? These are all examples of non-operating activities. So if you add all those up and then add them up to your operating, so our total non-operating activities amounted to $5,000. So together, we made $995,000 of profit before tax. Then if you take out the income tax, which again, I'll show you guys that I calculate in a future lesson, we are left with our net income. And again, it's the same net income. It's just more broken down. And then you also have something called earnings per share. Very quickly, earnings per share is just taking that net income and dividing it by the number of shares. Again, I don't want to get too deep into that, but this is just to show you what a multi-step income statement looks like and what you can expect to make probably on one of your exams. And again, really what we're talking about in this lesson is, what is it telling us? I'm not concerned about the format. I'm not concerned about calculating anything right now. I'm concerned with, do you understand what profit is? Do you understand what revenue is and what expenses are, right? Revenues, money that we've earned or fees that we've earned in exchange for our goods and services. Expenses, fees that we've paid to use goods and services. And profit is whatever's left over for us at the end of the day. Okay. Now, everything I just said is pretty much summarized here. You've got the operating and non-operating activities, or non-operating revenues, I should say. And I've given you the most common ones, like sales revenue, service revenue. Those are typically operating. But things like rent, interest, gains, those are typically considered non-operating, except for specific types of businesses. Like, sure, rent revenue could be operating if you are a real estate business, but generally, right, it's not. Same for interest. If you're a bank, okay, sure, interest could be operating, but typically, in an intro class, you're not a bank, you're not a real estate company. For operating expenses, like I said earlier, most of the expenses fall into this section. So cost of goods sold, salaries, depreciation, marketing, pretty much anything you could think of except interest, losses, and income tax. Again, there's probably some specific accounts that you can argue are non-operating, but this is an intro course. Remember that we're not going to be throwing the craziest accounting situations at you guys. And then if you take your revenues and your expenses, you're left with your net income. Now, this could be negative, right? If your expenses exceed your sales, your revenues, you would have a net loss. You wouldn't call it net income, you'd call it a net loss. It's ultimately the same thing. Those profits can either be reinvested in the business, which we'll get into in a moment. That would be called retained earnings, or it could be given to the shareholders, which we would call dividends. So if you own a business and you take profits out for yourself, that money is no longer part of the business, right? That would be called a dividend. But if you left the profits in the business, if you reinvested them in the business, then they would be called retained earnings. Okay, you don't need to write that down just yet. We're going to get into that in a moment. And then your earnings per share, as I said, is just your profit divided by the number of shares. So the more shares you have, of course, the smaller this number becomes. And for larger companies, public companies, this is really the number that matters. I don't really care that the company made $1 billion because I don't own the whole company. If I own just one share in that business, I care about what did that business earn for me on a per share basis. And that's why earnings per share is a really important figure. Okay. So that takes us to the second major financial statement called the statement of financial position or the balance sheet. Again, depending on where you are and what accounting system you use, balance sheet is actually the more common term, but the statement of financial position is the one you want to be using if you're following IFRS, which we do in Canada. In the US, we use balance sheet, same principle. So this one shows us our financial position at a specific point in time. And that's the first key difference between this statement and the previous one. The previous statement was for an entire period. It summarizes something, all the sales and all the expenses over a whole period from January 1st, let's say, until December 31st. It's an accumulation. But the balance sheet or the statement of financial position is at a specific date. It's a snapshot. It's not how much did I have yesterday or how much I have tomorrow. It's how much do I have today. Think of this as your bank account statement. If you print it out today, it's going to show you how much money you have today. Not how much you had yesterday and not how much you have tomorrow. You see, that's what a balance sheet is. It's a list of all of your account balances. So what are the sections? Well, we have three major sections. Assets, liabilities, and shareholders' equity. So let's talk about what those mean. Assets are basically any resources or any resource that is owned or controlled by the company that can be used to generate future economic gains or future revenue. Something that belongs to you, the company, that you will use to create income for yourself in the future. For example, a building, a truck, machinery, cash. Cash is an asset. Anything that is of value and is owned by the company is called an asset. And we have several little categories to understand. First of all, they can be tangible or they can be intangible. Tangible, most of the assets, first of all, are tangible. Tangible assets are assets that have a physical presence. Think of cash. You can see and touch cash. Whether it's literal cash or it's money in your bank account, cash is tangible. Inventory, tangible. Supplies, buildings, machinery, most things are tangible. Intangibles, for intangibles, we fall more into the realm of like intellectual property. A patent, right? A patent is an asset, but you can't see it. It's just a right, right? A patent is that nobody else is allowed to copy your invention for 20 years. That's the asset. And you can't really see it, but it does exist. And so it has value, and we call it intangible. You have other lists here, like, trademarks, patents, software, and, several others that we'll get into as the semester rolls on, or as this lesson rolls on, depending on how you're consuming this. Then you have current versus non-current. What's important to understand with assets is that you are going to use the asset at some point. Sometimes we call it liquidating. You're going to liquidate the asset. You're going to turn it into cash. So, for example, you have inventory, merchandise inventory that one day you'll sell, and that inventory will turn into cash. You have supplies, cleaning supplies that one day you'll use. Okay. Now, you're not in that situation. You're not literally turning it into cash, but you are using it, right? You're going to use it. It'll be gone. So, any asset that is used in a period that is 12 months or less is called a current asset or a short-term asset. Most of your assets will fall into this section. Right? When I buy cleaning supplies, it's not because I think I'm going to be able to use them for 5 years. I'm going to use it for a few months. It'd be a current asset. Cash. Well, cash is cash. It's already the most liquid you can get. Like I said, most of your assets fall into this. Non-current assets would be assets that are going to be used in a period that is longer than 12 months. We call these non-current assets or long-term assets, long-lived assets. Imagine a building, right? Well, a building, when you buy it, generally, it's to use for many, many years. Not just a few months. So imagine the difference now between a building or a truck or a computer and like a pencil or a box of paper towels, right? You see how the consumption of those two goods, assets, is different as far as like how long they will live, right? So if it's more than a year, we call those non-current assets. And then on the statement, it kind of looks like this. You've got all your current assets first, shows everything you own here, and then the non-current. And then when you put them all together, you have the company's total assets. So in this case, it'd be just over 2 million, 2.3 million. Remember, it's in thousands of dollars. You've got liabilities. This is the company's debt, basically. All of the financial obligations that the company has to honor. So these could literally be debts to be paid in cash. It could be goods that you owe customers who prepaid you. It could be, we'll get into warranties at some point. It could be many things. So any financial obligation is called a liability. And again, these could be current or non-current. The same cutoff, 12 months. But this is more of when do they have to be paid. If you owe somebody money and you have to pay them in 5 years, that's called a non-current liability. You're not paying it within the current year, right? Within 12 months. But a current one would be like you have to pay your worker next week for the salaries they earned last week, or you receive a bill for your electricity. You got to pay that next month. Anything that is a financial obligation or debt that has to be paid within 12 months is called a current liability. Okay, and again, when you put them all together, you put current first, then non-current, and you get your total liabilities. So this company has about $705,000 in total liabilities. And last but not least, you have shareholders' equity, or sometimes called owner's equity. Now, really, this can be seen as the actual value of the company. It shows you the portion of the company's assets that actually belong to the shareholders, to the owners. Now, if you're wondering, well, how come all the assets don't belong to the owners? The answer to that is debt. And that takes us to the accounting equation. Imagine a company has $1 million in assets, buildings, machinery, cash in the bank, inventory, all these things. Now you think, okay, well, that money should belong to the owner. But if the company has debts, which are liabilities, part of those assets actually belong to your creditors, the people that you owe the money to. So say, for example, you have $300,000 of debt. Well, that means 300,000 of these assets don't belong to you. They belong to the people you owe the money to. And whatever's left over is the owner's equity or the shareholder's equity. That is how much of the $1 million belongs to the owners. And that's why we call this the accounting equation, or the golden accounting equation. That's why it makes sense. It tells you that, okay, the company has this many assets. Who do they belong to? First, you got to pay your debt. And then if there's any money left over, it belongs to you. In personal finance, we call it a net worth. If you took all the assets you own personally and you subtracted all your debts, you would have your net worth. But in accounting, we call it shareholders' equity. Now, it has only two components. And again, in more advanced classes, it has many components, but really there are two major components. There's contributed capital, which has a few names. Sometimes we call it common shares. Sometimes we call it share capital. So contributed capital is all of the money that has been invested into the company by the shareholders. So if you put $50,000 into your business to start it, that would be called contributed capital, because it was capital contributed to the business by the owners. Okay. And then retained earnings, this is all of the reinvested profits. What I was saying before about profits is that the company could reinvest them. So let's say we make a $200,000 in profit this year, and we reinvest all that money into the business. We don't take anything out. Well, that would go into an account called retained earnings. Kind of in the name, right? Retained. It was retained by the company. Earnings is just another way of saying profit. And remember that profits that are not reinvested are called dividends. Those do not end up in your retained earnings. So you see, the more dividends we pay out, the less the company is worth. And that should just make sense. Don't overthink it. The more money I take out of my company, the less my company is worth. That's logical, right? So that's the link here. Dividends are profits that we're not reinvesting into the business. Great. So you can kind of see here a link between the first two statements, because the net earnings from the first statement, if I go back, this number here gets added to the retained earnings here, right? So they're related. And again, when we do the lesson on how to actually produce or prepare these statements, you'll kind of see exactly how to do that. But I'm just trying to draw a link here that the net earnings from the income statement are added to the retained earnings in the statement of financial position or the balance sheet. Okay. Hey everybody, sorry to interrupt. I just wanted to quickly ask you guys to follow me on Instagram. You can use the QR code here. You can type in my username. It's really the best way to reach me for questions if you do have any. If you wanted to have access to me more regularly, chat about certain things, talk to me privately, Instagram is really the best place to reach me. Next, you've got the statement of changes in equity. And now this is a statement that you won't have in every accounting system. Some accounting systems use a statement of changes in retained earnings. They're largely, they look different, but they have the same purpose. Now, a statement of changes in equity is very simple. It focuses on the section here, shareholders' equity of your balance sheet. And it breaks down the changes like the name suggests. So if you take a look, it starts with how much you had at the beginning of the year. Let's say in your contributed capital and in your retained earnings. And then what are all the possible things that could have affected it? Well, if you issued any new shares, that would be, so if you received any new investments, that would be contributed capital. So during the year, in this example, we received $5,000 in additional capital. Maybe the owners put in an extra $5,000 into the business. So we started the year with $645, but we ended with $650. Retained earnings. We started the year with $230,000 of retained earnings. Remember, reinvested profits. During the year, we made $796. Remember this number from the income statement? You see, it's being added to retained earnings. But then we also took out $25,000 in profits for ourselves. Those are the dividends. So you see that is coming out. When you see a bracket on financial statements, that's the equivalent of a negative number. Okay, so we're adding $796. That's reinvesting the net income, and we're taking out $25 for ourselves, leaving us with $1,001, or this would actually be just over $1 million in retained earnings. Okay, so that's kind of the point of this statement. Really, really short, just shows you, how did those accounts, or what made those accounts change over the course of this accounting period. And then you've got the cash flow statement, which is a subject on its own, but we're going to talk about it here kind of briefly. The purpose of a cash flow statement is to show you where your cash came from and where your cash went, cash specifically. Now, we're going to talk about many different things, but cash is actual cash, money in the bank, money in your pockets. And so you have 3 sections here, and these kind of are separated based on the activities that involved cash. So your operating activities would be all of your day-to-day operations, like paying your workers their salaries, paying your rent, paying for the electricity, buying inventory, and so on, right? These are all called operating activities. And this is kind of your good cash. You want most of your cash to be coming from here. We're going to get into that when we do the chapter on cash flow statements, but the logic there is I want my core business to generate my cash. I don't want to have to rely on non-operating activities to make money, right? So the cash from operating activities represents exactly that. How much cash we earned, or I should say received in this period from our main business. In this case, it would be $829,000 of cash coming in. Investing activities are activities that have to do with our investment accounts. So think long-term assets, like a building, buying buildings, selling land, investing in other companies. This has nothing to do with our day-to-day business. They're not operating activities, but they're still activities that affected cash. And so your cash either used by or cash from, depending on what it is. Here it's negative, which means specifically in the investing activities, we had a net outflow of $335,000 in cash. We spent $335,000 more than we received. And it's not bad, right, to be negative here. It just means you invested a lot of money. And then your financing activities, this has to do with any transactions related to how we raise money. How do we fund our operations? Sure, businesses would love to be self-funded, where you don't need to borrow money, you don't need to, but most businesses do borrow money, and many businesses do sell shares, right? So these are all called financing activities. It's how we raise our money. And so in this section, we have all of those transactions. Did you issue any shares? Did you pay any dividends? Did you borrow any money? Did you repay any debt? And you put it all here. And in this particular example, we ended up even, which means the money that we received, or the cash that we received, I should say, versus the cash that we spent, balanced out. Now, when you put all these together, the 3 totals, you get your total change in cash, which means in this particular year, 2025, our total cash increased. It's increased because it's positive by $494,000. And then look underneath. It means if we started the year with $106,000, we ended the year with $600. We started the year with $106. We had a net cash inflow of $494,000. We ended with 600. And if you go back to the balance sheet, that is the amount that you'll see on the balance sheet. So the balance sheet tells you, okay, you have 600,000 in cash, but the cash flow statement gives you the exact breakdown of how you ended up there. Okay, and we're gonna have a whole lesson on how to actually prepare all of these statements. Again, for now, what you want to understand is, what do they tell us? What is the information that we can pull from these financial statements? Okay. Now, the last part of this lesson is not really related to financial statements, but it's more about the different types of business entities or different ways you can organize a business. It's a pretty common question in most intro to financial accounting classes, intro to finance classes, understanding these three forms. First, you have proprietorships, sometimes called sole proprietorships. These are businesses where the owner and the business are not actually considered to be separate. So if you decide tomorrow, I'm going to start shoveling people's driveway or mowing people's lawns for as a little side business, you would most likely be a sole proprietor. Now, what are the kind of implications of that? Well, first of all, it's a very easy business to set up. There's really nothing official that you need to do. You could just knock on your neighbor's door and say, hey, I want to mow your lawn for $20. You're technically at that point a sole proprietor. You have a business and the business is you. You are the business. Now, the main thing here is that it has unlimited liability. Unlimited liability means you are responsible for all of the business's debt because you and the business are not actually considered to be separate entities. You are the same. You are the business is you. So, if you decide you're going to take out a $200,000 loan to buy the craziest lawnmower that exists, and then you can't pay that debt, well, you're on the hook for it personally. So that's kind of the big disadvantage of this form. Partnerships are the same as proprietorships for the most part. The major difference is that in a partnership, there's more than one owner. That's kind of the big difference. Again, owners in general partnerships have unlimited liability. Again, they are responsible for the debts of the business. Now, there are some exceptions to that. There's something called a limited partner, so you can write this if you want. Limited partners have limited liability. A limited partner is what you may sometimes call a silent partner. Okay, so this would be a silent partner. This is somebody who invested money into the business but is not actually involved in running it. They would have limited liability. But the partner that actually operates the business is no different than a sole proprietor. You would typically call that person a general partner or an operating partner, and they have unlimited liability. They are completely responsible for the debts of the business. Limited liability, I have it defined right here, is basically that they are not responsible for the debts of the business, can only lose whatever they've invested into the business. Which takes us to corporations. So corporations are kind of the most popular form of corporate structure. The main benefit is that, limited liability. The owners, which we call shareholders, are not at all responsible personally for the debts of the business. So if a business goes bankrupt, that's okay. They're going to lose, the investors, the shareholders will lose whatever money they've invested, but they're not going to lose more than that. The reason for that is because of the separate entity. The owners are considered separate legal entities from the corporation. So in the eyes of, say, the government, the business is its own person. The business can borrow money. The business can sue. The business can be sued. But the shareholders are separate entities from that. So if you're suing a corporation, you are not suing its owners. I've got a list here of advantages and disadvantages. The main advantage, as I said, is limited liability. Then you've got some other ones, continuity of life. With a sole proprietorship or even a partnership, if the owner dies, the business pretty much dies with it because the business is the owner. There's no separation. But in a corporation, if the shareholders die, the business lives on, right? The business has an indefinite life of its own. Ease of transferring ownership. This is another big one because with corporations, you own shares of the business. The business exists. It's an entity and it has shares. So if you want to just transfer your ownership to somebody else, you just have to sell your shares to that person. Whereas a proprietorship, you can't really sell shares because there are no shares. You are the business. You can't really sell yourself. So it's a lot easier to transfer ownership of a corporation. And then the opportunity to raise large amounts of capital. Typically, you have this with corporations, right? Corporations are able to sell, to issue shares to raise money. And so you will often have access to more money. Disadvantages? Well, loss of control by shareholders. The more shares you issue to raise money, then the less of your company you actually own. So as I sell shares, I'm giving away ownership of my business, and we have a loss of control there. Complex reporting procedures, right? There's a lot of rules when it comes to corporations. That's what this course is pretty much all about. Lots of accounting rules to follow, and you have to be very specific in how you do things. And then the potential for double taxation. Double taxation is basically, again, related to the separate entity between the owners and the company. Since they're separate entities, the company will be taxed, right, on the profit that it makes. And then if the owners take any money out for themselves, aka dividends, they're also going to be taxed because they're separate. So we call that double taxation. So that's it for this lesson. Now, again, this was more of just an intro lesson to this course. In the second lesson, we're going to drill deeper into our different types of activities. We're going to learn how do we actually deal with transactions? How do we record them? What's the process? And in future lessons, we're going to get into writing financial statements and then going really deep into all the details of like what is inventory and how do we deal with that? What are receivables and how do we deal with that? Okay, so if you enjoyed this lesson, please hit that subscribe button. Check out profjohnk.com if you would like to sign up to the entire suite of lectures, if you want to take some crash courses, if you want to check out some mock exams. And I will see you at the next lesson.